Being a real estate investor doesn't always require you to go to a bank, get pre-qualified, and call an agent. Sometimes that conventional path flat out doesn't work for the property or the investor. And under these scenarios, which are more common than you might think, people get stopped thinking that they have a credit problem or a money problem, when in reality, they merely have an idea problem. Enter creative, outside-the-box ideas of financing. And one of the more popular and profitable creative ideas is known as Subject to. I and countless of other creative real estate investors have built small and big cash flowing portfolios using this strategy. It's a powerful tool in your investing toolbox. But unless we change the way we go about it, the Subject to strategy is dead. And I'll tell you why. Let's go. Hi, my name is Matt Theriault, CEO of Epic Real Estate, where we show people how to invest in real estate so they can escape the daily grind and retire early. And it's through creative real estate investing strategies where this escape can significantly be sped up. And one of the strategies to do more deals and accelerate your escape is known as Subject to. It's when you purchase a property subject to the existing mortgage that is already in place. With a Subject to deal, you are not formally assuming the loan. Instead, you are taking ownership of the property and the responsibility of making sure the mortgage is paid on time, typically until you refinance or resell the property. In a nutshell, your name is on title as the new owner and you make the payments on the existing financing. But the seller's name stays on the loan and is ultimately the one responsible for the loan. This strategy has been used for years as an effective method of investing for both newbies and experienced investors alike. But its days, they're numbered, and I'll tell you why. And I'll begin by playing you a quick snippet of a conversation I recently had with a good friend of mine, Jason Hartman, host of the Creating Wealth podcast. It's the longest running real estate investing podcast on iTunes. Really smart guy. Here, listen to his housing market prediction, and then I'll explain how this is going to impact and probably downright kill Subject to investing as we know it. And then I'll share with you what you can do to keep it alive in your creative investing toolbox. You know, I was listening to a podcast the other day, driving through the canyon over here in Vegas, and the Rebel Capitalist Show. Surprise, surprise, you were the guest, and you were talking about one of my two favorite subjects of the day right now are debt and inflation and how to use those two things to build your wealth for the future. But you closed out that episode, that interview, with a prediction that you're making to once we get out of this madness that we're in of a housing market and the economy. And I just wanted to invite you onto the show, and I found it really compelling. So I wanted to help you memorialize it. And when it comes to fruition, you can go and tell everybody that you told him so.
and if it doesn't come true, this will be thrown back in my face.
We'll just hit the delete button and everything will be fine.
That's right. That's right. Well, thanks, Matt. I have a big prediction. You know, a lot of people are talking about the everything bubble and, you know, predicting a crash and all this kind of stuff. This stuff is complicated, like everything in life. You know, there are many nuances to it, and I'm not talking about nuances to the whether or not, you know, what might go right or wrong in the prediction. I'm talking about the prediction itself is nuanced, right? Mm-hmm. And you know, we could have a slowdown. We've got forbearance issues. We've got eviction moratoriums. We've got very low interest rates, which very likely, which have to ultimately become higher interest rates. We have had tens of millions of people who are either refinancing their houses or buying new houses. And either way, they're getting the lowest mortgage rates in the history of the world. Overall, we have some of the lowest interest rates in 5,000 years. Yes, there are people who have kept records back to Egyptian times of what the interest rates are, right? So rates are insanely low. And I believe rather than the usual talk we hear where people say, well, when rates go up, we're going to have a housing crash. Okay, I see what they're saying, and everybody understands that concept because, you know, it will definitely cool the market down if rates go up. But what they are not talking about that's critically important is the supply side of that equation, and the motivation for all those tens of millions of people I just mentioned to keep their houses because they have an asset. And when I say asset, I don't mean the house, I mean the mortgage being an asset of unduplicatable, um, ultra low interest rates.
Yeah.
And if you ask me, Matt, they are going to fight tooth and nail. They are going to fight really hard to keep that mortgage asset. And that is going to constrict housing supply quite dramatically.
Right.
We already have a huge housing shortage, but I think it could get worse. If someone's got a 2.5% interest rate, and then the rate at the time is 5%, which would still be a historically low rate, right, for a 30-year fixed rate mortgage. If the rate at the time is 5%, that's not 2.5% higher. It's 100% higher. It's double. So people, I think, will be very much incentivized to hang on to the properties they've got and either one, improve them to stay in them. So they might add a room, they might repaint, they might redo the yard, they'll do something to make the house nicer. I don't know what they'll do, but I think they're going to be incentivized to keep the house. Or they might turn it into a rental property rather than selling it. So it's going to be impossible to duplicate that low mortgage because you cannot move the mortgage when you change houses. The mortgage is immovable. That's going to be the incentive, and that's going to further constrict housing supply beyond the shortage that we already have.
One thing to note from Jason's prediction is how the current housing supply crisis might not improve anytime soon, which would support a strong seller's market for a long time to come. That alone could hinder the effectiveness of subject to investing, but certainly wouldn't kill it. There's something bigger in Jason's prediction that likely would, though. To really grasp it, you must understand the history of the subject to deal, because this isn't a new form of real estate financing. You see, in the 50s and into the 60s, buying property subject to was a common practice. Homeowners would sell their property this way to a buyer that had insufficient credit. It happened all the time. But over time, banks evolved and made it easier to buy houses with personal credit. And because of this, the subject to transaction became less popular. And then in the mid-70s, as interest rates started to rise, the subject to transaction took an even bigger hit when banks began inserting a due on sale clause into their loans. A due on sale clause, also known as an acceleration clause, is a provision in a mortgage document which gives the lender the right to demand payment of the remaining balance of the loan when the property is sold. It is a contractual right, not a law, contrary to popular belief, nor is it a bank's obligation to call the loan due, but merely their option to. Here's why banks started to put this into their loan documents. Home buyers were taking over existing loans rather than borrowing new money from banks because the interest rates on the existing loans were lower and eventually much lower. Thus, the banks weren't lending new money out at the higher rates, and rates that reached as high as 18% in 1982. Now, they argue that the reason for the restriction was to be able to police who was living in the property, the collateral for their loan. Weak argument, though, and here's why. You see, this was a very small window of just 2 or 3 years where banks were enforcing this due on sale clause, making it problematic for subject to deals. But banks started to pull back on their due on sale enforcement when interest rates began to plummet in 1984. It wasn't really about monitoring who was living in the property at all. It was all about the money. To this day, banks are still unlikely to enforce the due on sale provisions because interest rates have been trending downward ever since. And it makes sense that they don't enforce it right now. I mean, they'd lose money if they made it a common practice. Now, with regard to Jason's prediction, with interest rates being at a place where they can't go much lower, and despite what the Fed is saying about keeping the rates low, they have been on an uptick since early January. Now, we may see them slide up and down along the way, but to support our over-leveraged monetary system, the Fed will have to increase rates at some time and over time to keep inflation in check. It's really the government's only plan, along with increasing our taxes, to recover from the monumental stimulus bills that we've recently passed. Not to mention the Godzilla-sized infrastructure bill on its way from the Biden administration. The bottom line, when rates increase to a point where it becomes profitable for banks to enforce their due on sale clause again, just like they aggressively did in those few years in the early 80s, you can bet they most certainly will, thereby killing the subject to transaction under most circumstances. So, what can you do about it? Why do you want to figure out a workaround? Yes, you can do something about it, and here's why you want to. When you successfully execute a subject to transaction, 1, you don't have to qualify for a loan. 2, you will have the advantage of the owner's lower interest rate. 3, you will have the advantage of the owner's amortization schedule based on their time in the loan. 4, you will have instant ownership in the property. You don't want to give up those benefits just because the bank's increasing inclination to execute the due on sale clause. And besides, the benefits don't stop with just you either. The seller benefits too by 1, receiving an instant solution to their urgent problem, 2, preserving their credit rating because you are making their payments, and 3, eliminating their closing costs, fees, and need for repairs. Now, I use the word workaround, and I'll let you in on what it is in a second, but if this feels like we're playing in the gray area of the law, we're not. You can still purchase a property subject to on listed and off-market properties because there is nothing illegal or unethical about buying a property subject to. And to assure that you don't create any unnecessary challenges for yourself, you want to follow these best practices. First and foremost, use a trusted real estate attorney throughout the process of the deal to protect you and the homeowner. It is still a real estate transaction that must follow real estate laws, both state and federal. Second, ensure that all aspects of the transaction are in writing, especially the seller acknowledging that they're fully aware of the subject to aspect of the transaction. Third, have a backup plan. Lenders, they rarely enforce the due on sale clause because they prefer a performing loan over a foreclosure. Now, while the loan being called due is highly unlikely for now, it is still possible. And as the rates increase, so does that possibility. Fourth, use a third-party note servicing company to hold the funds and make the seller's mortgage payments. It's also not a bad idea to give the seller limited access to the account in the interest of their comfort that the mortgage payments are being made on time. Fifth, you will need to open up a new insurance policy, naming you or your company as the insured. This limits liability. All right, now for the workaround that you've been waiting for to keep this strategy alive in your toolbox. You see, banks don't typically look for reasons to exercise the due on sale clause. But if they're notified that the property has been sold without paying off their loan, they could. And as mortgage rates increase, they're likely to. The primary way to keep the bank from being privy to your subject to purchase is by incorporating a land trust in the transaction. And you can watch the video right here on how to do that. And I'll also put the link to it conveniently in the description below for you. The land trust will keep most of you and your seller's secret from the bank. And there's one person though that will eventually blow the whistle on you, and that's the insurance company. You see, the insurance company will notify the bank, as they are the loss payee in the seller's policy, that there's been a change to the insurance. So the one way to deal with this issue is to keep the seller's insurance in place and current. So if your strategy is to hold long-term for cash flow, make sure that you calculate the double insurance payment and refer to number 3 of best practices. Have a backup plan in case the bank does call the mortgage due. Now, purchasing subject to is still relatively risk-free if your plan is to refinance or flip the property within a few months or so. Just know that when the rules change, specifically when the interest rates rise, your strategy to win will have to change with them. So what did you find most valuable? Let me know below. And who do you know that needs to see this? When their name comes to mind, please share with them. Oh, and if you're already subscribed, I pulled this video out special for you to watch next. Otherwise, I'll see you next time. Thanks for watching. Take care.